In the world of accounting, we don't look at what people say they value. We look at the general ledger, because the ledger never lies. I've audited portfolios for the top 1% and bank statements for people living paycheck to paycheck. The difference isn't always the salary, it's the math. Most people aren't bad with money. They are simply victims of invisible leaks. If you're working harder every year but your net worth is staying flat, you aren't stuck, you're leaking. Today, as your virtual accountant, I'm going to plug those leaks. This isn't financial advice. It's basic arithmetic. Habit 1. The microbleed. In a firm, we call this unallocated overhead. In your life, it's the $12 subscription you forgot about, the $6 coffee, and the convenience fee on your dinner. Humans are biologically wired to ignore small numbers, but as an accountant, I see the cumulative weight. A $40 a week convenience habit is $2,080 a year, invested at an 8% return. That is $100. 0 over 20 years. You didn't just buy a coffee, you bought a $100,000 retirement delay. The professional fix. Audit your last 30 days of transactions. If you didn't use it, or if you could have walked to get it, delete the app. Treat your personal capital. A Fortune 500 company treats its budget. The second habit is financing a depreciating identity. This is the most dangerous trap in the modern economy. People use future money, their credit cards and loans, to buy things that lose value the moment they're touched. From an accounting standpoint, you are trading a high-interest liability for a dying asset. It is a mathematical suicide mission. The professional fix, the 72-hour rule for assets. If the item doesn't appreciate in value, you must wait 72 hours before buying. If you can't pay cash, the answer is no. You aren't building credit. You're building a cage. Most people view taxes as a seasonal weather event. They just hope for a sunny day in April. That is a massive error. Taxes are your largest lifetime expense, period. By not understanding tax-advantaged accounts or basic deductions, you are effectively working from January to April for free. Wealthy people don't evade taxes. They strategically optimize them. The professional fix. Treat tax planning as a monthly task, not an annual one. If you don't know the difference between a Roth and a traditional account, you are leaving 6 figures on the table over your lifetime. Finally, the lifestyle creep. As your income goes up, your necessities magically expand to meet it. This is why I see doctors with $300,000 salaries who are broke. If your expenses rise at the same rate as your raises, you are on a treadmill, and the faster you run, the more exhausted you get, without ever moving an inch forward. The 50/50th raise rule. Every time you get a raise or a bonus, 50% goes to your lifestyle, and 50% goes directly to your wealth account. You still get to celebrate, but your future self gets a seat at the table too. Math doesn't care about your feelings. It doesn't care if you had a hard day and deserved a splurge. It only cares about the balance. You can have the best intent in the world, but if your habits are keeping you poor, no amount of hustle will save you. Change the habits, and the numbers will follow. It's that simple. If you want the spreadsheet I use to track my own leaks, check the link in the description. And if you're ready to start treating your life like a business, subscribe. Let's get your ledger back in the black.